Most people believe investors lose money in the market. They imagine loss as something loud and visible, prices collapsing, charts bleeding red, panic spreading, capital vanishing. This belief is comforting. It suggests failure is external, caused by bad luck, poor timing, wrong assets, or misleading information. But this belief is wrong. Most investors lose long before the market ever touches their money. They lose before the first trade, before the first position, before the first dollar is exposed to risk. They lose at the level of thinking, identity, and expectation, where no chart can warn them and no indicator can save them. By the time money is actually lost, the outcome has already been decided. There is a moment in every investor's journey that determines almost everything that follows. It does not appear on a balance sheet. It leaves no transaction history. It creates no visible scar. It is the moment, often unconscious, when a person answers this question: what do I believe investing actually is? Most people never answer it deliberately. They inherit an answer. From social media that celebrates profits but hides losses. From headlines that glorify returns without mentioning drawdowns. From success stories that erase years of boredom, stress, and uncertainty. That inherited belief becomes their internal operating system. And if that operating system is flawed, no amount of intelligence, effort, or information will compensate for it. The most expensive illusion: preparation equals readiness. New investors are rarely careless. They are often diligent, motivated, and serious. They read books, they watch hours of content, they follow respected voices, they analyze charts, they feel prepared. But preparation is not the same as readiness. One of the cruel paradoxes of markets is this: information does not reduce uncertainty. It increases your exposure to it. The more you learn, the more variables you discover that cannot be controlled. If you mistake information for control, the market will punish you quickly. Markets do not primarily punish ignorance. They punish miscalibrated confidence. An inexperienced person who knows they are inexperienced behaves cautiously. An informed person who believes knowledge grants control acts decisively and often destructively. Why intelligence is not a reliable edge. This is deeply uncomfortable for intelligent people. Markets are not academic exams. They are not logical puzzles. They do not reward clever reasoning. They reward behavioral stability under uncertainty. Highly intelligent individuals often struggle because they overestimate their ability to reason through randomness, underestimate how stress distorts judgment, equate complexity with superiority. Markets do not reward complexity, they reward robustness. A simple system followed consistently will outperform a brilliant system executed emotionally. The first invisible loss: misunderstanding the game. Most investors believe they are playing a game of prediction. They ask, where will price go? Which asset will outperform? What is the next big opportunity? But markets are not designed for prediction. They are designed for risk transfer. The real game is not, can you be right? It is, can you survive being wrong? Every investor will be wrong, often repeatedly and sometimes painfully. What separates survivors from casualties is whether those errors are survivable. If your mental model assumes correctness is required, you will defend losing positions, delay admitting mistakes, increase risk emotionally, confuse conviction with stubbornness. The market feeds relentlessly on this behavior. Why being right is a trap. The desire to be right is one of the most dangerous impulses in investing. It pushes investors to ignore opposing evidence, rationalize losses, personalize outcomes. Markets do not care whether you are right. They care whether you remain solvent. Correctness without survival is irrelevant. The second invisible loss: identity confusion. One of the least discussed reasons investors fail is identity mismatch. Most people enter markets without answering a critical question: who am I supposed to be in this environment? Are you a trader, an investor, a speculator, a capital allocator, a risk manager, or simply someone who wants money to grow and hopes the market will do the work? Identity matters because behavior follows identity, not intention. Many people claim to be long-term investors. Their behavior says otherwise. They monitor prices obsessively. They react emotionally to short-term volatility. They seek reassurance during normal drawdowns. This is not a character flaw. It is a structural mismatch. Why role confusion is so costly? Each role in the market obeys different rules. Traders optimize entries and exits. Investors optimize time and compounding. Speculators accept volatility as cost. Capital preservers minimize unnecessary exposure. When these roles are mixed unconsciously, the investor inherits the risks of all and the advantages of none. This is why so many investors feel exhausted, anxious, and perpetually uncertain. They are playing multiple games simultaneously without realizing it. Markets exploit this confusion effortlessly. The third invisible loss, emotional timing. People rarely enter markets when risk is lowest. They enter when participation feels socially validated. This usually occurs when success stories dominate conversation, recent performance appears convincing, skepticism feels outdated, caution feels unnecessary. This is not accidental. Markets expand participation when enthusiasm is high because liquidity is abundant. By the time investing feels obvious, the margin for error is already thin. Why comfort is often a warning signal. Experienced investors learn something counterintuitive. Comfort is not safety. Discomfort is not danger. Comfort reduces vigilance. Discomfort sharpens it. Markets are often most dangerous when they feel calm and reassuring. They are often safest when they feel uncertain and uncomfortable. Beginners rarely understand this until after losses occur. The market as a psychological amplifier. Markets do not create your weaknesses. They magnify them. Impatience becomes overtrading. Fear becomes premature exits. Ego becomes refusal to adapt. Greed becomes overexposure. This is why market losses feel deeply personal. They are not attacks. They are reflections. Most investors do not fail because they lack opportunity. They fail because they misjudge themselves. They believe the market is the battlefield. In reality, the battlefield is internal. By the time the first loss becomes visible, the real defeat has already occurred. Survival, illusion, and the discipline nobody wants. Recognizing the problem is not enough. What matters is understanding why it persists and why so few escape it. The hidden danger of early success. One of the most misunderstood risks in investing is early success. Losses are visible, painful, educational. Early success is seductive. It whispers the most dangerous lie in markets. You understand this. When beginners experience early gains, luck is mistaken for skill, flawed processes are validated, risk tolerance increases prematurely, humility is delayed. Markets often reward new participants just enough to anchor them emotionally, then change conditions. Many long-term failures began not with mistakes, but with early brilliance. Why markets love confidence without structure. Markets do not prey on ignorance. They prey on unearned certainty. An uncertain investor hesitates. A confident investor commits. Commitment without structure is highly profitable for someone else. The difference between those who lose and those who quietly compound wealth is not intelligence. It is structure before conviction. The illusion of recovery speed. After losses, another destructive belief emerges. I need to make it back. This belief instantly alters behavior. Risk increases, patience disappears, discipline erodes. Markets do not punish the initial loss. They punish the reaction to it. Most investors fail not because they were wrong once, but because they refuse to slow down afterward. Why most investors never truly recover. Financial recovery is possible. Psychological recovery is rare. After significant losses, investors often experience loss of confidence, hypervigilance, overanalysis, paralysis, or reckless aggression. Without a framework, every decision feels heavy. Every outcome feels personal. This is not a strategy problem, it is an identity fracture. Once trust in one's own decision-making breaks, many investors never fully regain it. The market is not unfair, it is unforgiving. Markets do not promise fairness, they promise consequences. Uncertainty is permanent, volatility is structural, loss is inevitable. The problem is not that markets are harsh. The problem is that investors expect comfort. Comfort is not part of the contract. The real objective of investing. Investing is not about making money. It is about not being forced out of the game. Money is the outcome. Survival is the objective. This reframing changes everything. Position sizing becomes conservative, drawdowns become expected, decisions slow down, emotions lose authority. Most investors never make this shift. They chase outcomes instead of designing for endurance. Before a single unit of capital enters the market, something must already exist. Not a strategy, not a prediction, not a portfolio, a personal operating system. It answers, how much volatility can I tolerate without changing behavior? What rules govern my risk exposure? When am I allowed to act, and when am I forbidden to act? What conditions force me to stop, not push harder? Most people skip this entirely. They enter markets with tactics instead of structure. Those who last do not look exceptional. They are rarely loud, rarely urgent, rarely emotional. They expect drawdowns. They design for error. They respect uncertainty. They prioritize consistency over brilliance. They do not seek to outsmart the market. They seek to avoid self-destruction. It is not glamorous. It is effective. You do not lose because opportunity is scarce. You lose because preparation was shallow. You do not fail because markets are unfair. You fail because you expected fairness. You do not struggle because you lack intelligence. You struggle because intelligence does not protect against emotion. If this feels uncomfortable, that is intentional. Because real investing does not begin with excitement. It begins with humility. And that is why most investors lose before they even start.